Hello, Greg. How you doing, mate?
Good, Woody. How you going? All right?
Yeah, not too bad, not too bad. I thought it would be good to just catch up at the end of the week. Thanks for covering for me last week, by the way. I
Yeah,
had a
no
nice week
worries.
off and nice and refreshed now.
Yeah, well, as I
Um,
said, I was actually pumped to do it because I'd had quite a few conversations with Ryan, and I thought, it's a good opportunity to put those conversations in front of all our clients, and I thought it was a really good chat. So happy
yeah,
to
it
do it,
was.
mate.
I listened to it on the weekend. It was pretty fascinating. We're going to have more of those conversations in the weeks to come.
Yeah, I was going to say there's plenty to follow up on that. So
Yeah, but this week, Greg, I just thought we'd catch up. You've been talking a lot about the inflation trade at the start of the week, and I thought it would be really good to discuss a few of the ideas you had behind that and your thoughts on it.
yeah,
Um, there's been a lot of market action this week. Everything seems to have taken a bit of a breather, like the Dow's down, gold's taken a back step, everything, including oil as well. The only thing that seems to be, including bond yields too, the only thing that seems to be rising is the US dollar. And I think that's giving the authorities that be a bit of a headache. So I wanted to discuss a few thoughts on that.
yeah,
But first, I thought perhaps we could just clarify a couple of things that we've had a few. Obviously, you sent out a communication with a slight evolution to the way that we're going to communicate to people going forward. And
yeah.
it's created a little bit of confusion. I always find we try our best to communicate these things properly, but it's got a few people worried. So I just thought we could just clarify what you meant by your email.
Yeah, absolutely. And whenever you do, communicate changes, there is always some concern about what those changes actually mean. So for those listeners who might not have seen what the communication is, effectively what I proposed and that we've brought in is to tell our editors we don't need to do a scheduled weekly update every week. Now that doesn't mean that you're not going to receive any updates. What I'm trying to improve and get away from is the, I guess, schedule of, I've got a weekly update to write this week. What am I going to write about? And, just maybe, and I'm being, very honest here. Like, I think when you have a schedule like that, it tends to lead to the production of information that may or may not be useful. So what I'm trying to do is get a situation where the editors email their clients on whatever their product is when there's something that they really need to tell them. And I don't want them to wait for the weekly update. If something has happened in the market that day, if there's been a company announcement, if there's a lot of volatility in markets that is affecting the portfolio, I want that update to go out as soon as possible. I don't want it to wait until the week after when the update is due. And I think by doing it this way, we will increase the quality of our communication and decrease the amount of, needless communication and emails that hit people's inbox. And I'm very cognizant because it happens to me as well. I'm on a lot of different distribution lists. I get a lot of emails, and I find that a lot of companies just email you for the sake of it. Oh, we're just keeping in contact. Oh, just catching up with this. I want our communications to be valuable, and I want our clients to only receive communications from us when we really have something important to say. And that might be a communication about how the portfolio is positioned. It might be a communication about an announcement from a company that, we might say, okay, look, it changes the recommendation from a buy to a hold, or, this is now a sell recommendation. And I want that information to go out quickly. Now, that, once again, that doesn't mean that you're not going to receive as much communications. For a lot of our investment services that come with monthly issues where there's a stock recommendation, none of that's going to change. This is really about how we communicate in the meantime. So for some guys, and I've told the editors, you can continue to communicate on a weekly basis if you think that best serves.
Or even on a daily basis.
Yeah, or even on a daily basis. Yeah, I mean, the idea is quality over quantity. So I want the guys to focus on what are they telling subscribers, and is that information valuable, and do they need to know about that now? And if the answer is yes, then we send out an email. If it is filling in an email for the sake of filling in an email because it's your time to send out a weekly update, then that's what I want to get away from. So if you're at all concerned about getting less information with this, I don't think you should be. And let's give it a month or so, and I'd be more than happy to get your feedback after a couple of weeks or a month or two of you seeing how this new sort of system plays out. And we're trialing it. We'll see how it goes. And if people don't like it, you can write in and tell us, and we'll make some adjustments. But I'm hoping this just ends up being quality over quantity and getting more relevant information when you need to hear it, pretty much.
Yeah, I think it'll actually be a better thing. But we'll see. We'll always listen to readers' feedback and
absolutely
react to how they like the service to be.
Mm-hmm.
Cool. Well, thanks for clearing that up, mate. So let's get to the inflation discussion then. Now, you started the week off talking about inflation and how it's kind of the accepted narrative really at the moment, and there's no real anyone questioning that it's coming. The real thing that people think is that the question is how fast and how big is it going to be. Yep. But you sort of question the validity of maybe not that argument, but you basically made the point that when everyone's thinking the same thing, it's probably right to stand back and question it. So I was going to get your view on that and why you kind of started thinking about these things this week.
Yeah, I think what I like to do, especially on the weekend, is not really read, but look at the headlines in the business sections and especially, personal wealth, personal finance, that sort of stuff, because that is really tells me what the market and what the mainstream sort of thought process or what the consensus thought process is. And when, in consecutive weeks now, I've just seen a lot of commentary around how to position your portfolio for coming inflation. What's a good inflation trade? Inflation is coming. What do you do about it? All these sorts of things. Now, to try to break it down without getting too much into the weeds, everyone knows asset price inflation has been around for a long time. I mean, the markets have just gone up and up and up, and that's to do with currency debasement. And a lot of these things that we discussed in the Life at Zero event, which we've talked about here on a number of occasions. And I don't think that's going to change at all. But the way that these things shift is now people are talking about inflation at the consumer price level. And for many, many years, we've had disinflation or in some instances, say technology outright deflation, which is holding consumer price inflation down. Now, most people that live in the real world realizes there's still lots of inflation out there, but the broad way that the government and the central banks, calculate it and communicate it is to say that CPI inflation is very low. Now, over the course of the COVID shutdowns and the response to that, it's injected a lot of money and a lot of stimulus into the economy in a short space of time. That is clearly leading to a bit of an inflationary bump where you're seeing prices rise purely because the amount of the fiscal stimulus that's gone through into the economy in a short space of time. Now, the market is extrapolating that into, sustainable inflation. Inflation is going to pick up. It's going to run away. Oil prices are increasing. All these things that are happening that is leading the market to think this is going to be a sustainable inflationary response, and this is how you need to position your portfolio for it. Personally, I think inflation, the groundwork for coming inflation is starting to be laid, but you just don't flip from 10 to 15 years or even longer of a disinflationary environment into high inflation. It takes a number of years to transition, and I think we're going to need a lot more government and central bank activity and stimulus to create genuine sustainable inflation that flows through into higher wage rates that then flow into higher prices constantly. So my concern is that this narrative has become widely accepted and priced in when it's not actually true. Like that, there's still a lot of things that need to happen in order for that to play out. And I've been keeping my eye on the US dollar. So the US dollar is obviously the world's reserve currency. It's probably one of the most important asset prices to keep an eye on. And
it's also one of the only things that has increased this week as well.
Well, you know what? The US dollar bottomed in early January, and it's been rising ever since. Now, I'm not sure what people have been doing, but in the past couple of months, all I've heard is that the US dollar is, cratering and it's going to collapse and all that sort of stuff. But the US dollar index is measured against a bunch of other fiat currencies. So yes, the US dollar is, certainly not looking good against Bitcoin and oil. That oil's been rising quite strongly. But against a basket of other currencies, say the euro is its most important opponent, it's actually been rising. And when the US dollar rises, that is telling you that the market is becoming a little bit more risk averse. It's not betting on inflation. There's been a shift in the way that the market's viewing these things. And in the inside of this week, I put a level on the US dollar index, which I think was about, from memory, 92.5 on the US dollar index, that if it breaks above there, then it increases the odds that the US dollar is going into a bit of an uptrend phase. Now, if that happens, that's going to make it very difficult for equity markets to continue to rally. I'm not saying it won't, but it just means that there might be a little bit more risk averseness coming into the market. So there's a few things to look at, and I'll continue sort of writing about this in the weeks to come. But I guess what I wanted to highlight really this week is that, when everyone's on the same side of the boat of saying this is going to happen, you need to take a step back and say, well, if everyone thinks this, then I'm not sure who's left to buy into that narrative, and therefore can prices keep going in that direction. So at the very least, I think it's probably worth stepping back and questioning that and seeing, what other areas of the market might be worth moving into.
Talking of stepping back, one of the things you did was you presented a pretty compelling chart that showed the bull market of since 2007, really, growth stocks have been in a sustained rally. And you mentioned that 2020 may have been the blow up or the blow off top, or would you say I mean, I don't want to speculate, but could it have been the melt up year? And is that there's been a switch to the traditional value plays, right?
Yeah, absolutely. I mean, that chart was really, I guess, to show in 2020 how a long running theme essentially got out of hand, and that's to do with the fact that the global economy shut down and tech stocks were the prime beneficiaries of that. So all this capital that got put into the markets via all the stimulus was obviously looking for a place to invest, and it went into these growth stocks, and it's gone into them at such a pace and at such a volume that a lot of growth stocks, I'm not saying all of them, there's still some good growth stocks out there that, when you look at interest rates, when you look at where bond yields are, they're not overly expensive, but there's some ridiculous companies out there that are genuinely bubble-like in their in their valuations. And I've picked on Tesla before and Afterpay in Insider, because I think they're sort of the pin-up stocks for this type of valuation. So the idea behind that chart was to say, the thought process of the market is that growth stocks overvalue stocks, but clearly that changed at the start of the year, and there's been a shift in the way that the market thinks about the valuations. And I just think that's a case of some of these valuations are getting so ridiculous that now money is starting to, or capital is starting to rotate into these other sectors. And a lot of that has to do with the fact that now that there is sort of light at the end of the tunnel, the economy's opening back up. So the traditional sort of, cyclical stocks like banks and oil companies and things like that are starting to get money flow into it. But I think that flow has, or that theme itself has sort of now exhausted itself. It's, I'm a long-term value investor, so I'm a proponent of buying these sort of stocks, but I still think in the short term, you need to accept when, perhaps the short term has been priced in. And I think, oil's had an incredible run, and I recommended oil stocks for my subscribers back in January. So I'm not saying that, you shouldn't be invested in these, or you shouldn't be interested in these sectors, but I'm just saying from a very short-term perspective, oil's gone from negative to, back where it was at the 2019 highs in a matter of months, or 6 to 12 months. So you've just got to look at these things from a rational perspective and say, well, hang on, it's had a pretty good run. Perhaps it's probably due for a few months of correction and consolidation now, and then you can say, look to take a position once you've gone through that corrective period.
The oil's slight correction this week, is that down to the rising US dollar as well, do you think?
Yeah, I think all these things are connected, and when the US dollar rises, it's obviously going to put pressure on anti-US dollar trades, which are effectively commodities, which is why gold is continuing to struggle. Even though gold looks like it's trying to put in a bottom, it's really not moving away from that. But in Aussie dollar terms, gold's looking a lot better because now the Aussie dollar is coming under pressure because of this US dollar strength. So from from an Aussie investor's perspective, the gold market's starting to look more interesting because Aussie dollar gold prices are rising. Aussie dollar gold stocks, as I've also pointed out, have copped absolute battering over the past six to 8 months, and they're starting to look, really compelling value at the moment. So, there's certainly areas where you can see maybe capital moving into over the next couple of months if this inflation trade is going to take a bit of a breather.
And just the final question, really, for the coming months. So you're not saying that inflation is definitely coming. You're not saying that it definitely isn't coming. But one thing that
I'm sitting on the fence.
But one thing you do know is that the government and the central banks are going to step in and re-stimulate whenever there is a bit of a wobble, and that is basically life at zero, isn't it? I mean, that's the narrative and the landscape we're looking at.
Yeah, and look, it's a long-term sort of narrative, is that central banks and governments will only step in and do big things when there is a problem, and they're not going to do it when the market's corrected 5%. But when the market's corrected 10%, maybe 15%, 20%, people are starting to panic. They're gonna step in and do something. And I've said before in the Life at Zero presentation, if you think what we've seen so far is big and groundbreaking, we're going to see more of it. Like there'll be, and we've talked about modern monetary theory. Like we're sort of doing that, in a light way, LITE way, but in the next downturn, modern monetary theory, where the central bank directly finances the government, that's probably something we're going to see more of. We know central banks are all experimenting with central bank digital currencies, which gives them far more flexibility in directing the way people receive and spend money. America just voted in a quasi-socialist government. These experiments will be, in my view, will be tried in the next couple of years, which is the idea behind Life at Zero. You can sit in cash and wait for a crash, but is the crash ever going to be big enough for you to move into the market? And I think by sitting in cash and waiting for this, inevitable correction, waiting for a correction that may never happen, is almost, it's that frog in boiling water analogy that we used. At some point you're just going to realize that it's too hot, and your cash is inflated away in many different ways. So that's why I suggest, get into the market, but do so in a sensible way and reduce your risk as much as possible, which is what we're trying to do.
Thanks, Greg. Appreciate your time. That's cleared up a lot of things, and we'll continue these conversations. And we'll bring our mate Ryan Dintz into it from the crypto perspective as the weeks progress.
Absolutely.
So, thanks, Greg. Cheers for your time.
No worries. Cheers, mate.